Welcome to the deep dive. We are really cutting through the noise today. We're aiming to bring you a data-driven, actionable framework for building real wealth.
Yeah, and it's all synthesized from some pretty solid research and analysis based on this, this one powerful, simple philosophy.
The philosophy, it's kind of our guidepost for this whole discussion, right? It's
Yeah.
about maximizing your chances of success, no matter what the headlines are screaming or what the economy's doing.
Exactly. It's like a financial shortcut to being well-informed, but, and this is key, you do need to understand the why, the data behind the simple actions.
So our mission today, our deep dive, is really into this idea of the save-invest continuum, figuring out, when should you be laser focused on cutting costs and when does it make more sense to pivot to optimizing your investment strategy.
And we're definitely going to challenge some, let's say, deeply held financial myths along the way, like the idea that all credit card debt is automatically evil.
It all seems to boil down to, well, these three simple words. Words you could almost, print on your wall if you're an investor.
I should probably start with a story, actually. It illustrates the core principle perfectly.
Okay, yeah, let's unpack this. There's an anecdote that, honestly, it really shocked me when I first heard it. It just shows how consistency can, overcome even really destructive habits. It's about a late grandfather.
Right. This gentleman, he struggled fiercely with a gambling addiction. He actually retired quite young at 55.
Wow, 55.
Yeah, and he was lucky he had almost no living costs because he was living with family. He had this guaranteed income stream, about $2,200 a month, part pension, part Social Security.
Okay, so stable income, low costs. Sounds good so far.
It should have been, but the problem was, over his 26-year retirement, he gambled away every single cent of it. Mostly high-stakes card games, apparently. Blackjack, pay-gow.
Oh, man. So when he passed away?
Nothing. He had absolutely nothing to his name when he died in May 2019. It's a really sad story about addiction, obviously.
But here's the kicker, the data-backed part that just floors me.
This is it. If he had just taken half of that $2,200 a month, the money he was literally setting on fire anyway.
Yeah, just half. $1,100 a month.
And consistently invested it, say, into a simple, broad U.S. stock market index fund.
You would have died a millionaire.
A millionaire. The math is just undeniable. And what makes it even more powerful is when this happened.
Right, the timing. His investment timeline would have included the entire 2000s decade.
Which was brutal. You had the dot-com bust and the great financial crisis packed into those 10 years, one of the worst decades ever for stocks.
Just the sheer consistency, the ritual of putting the money in every month.
It overwhelmed all that volatility. It basically guaranteed wealth growth over that long period.
And that, right there, is the core idea we're digging into today. Just keep buying. JKB.
Yeah, the technical term is dollar cost averaging, DCA, but just keep buying.
All right.
It has that psychological punch, It makes it a habit.
It turns investing from this stressful, should I buy now, should I wait kind of thing, into something mechanical, like paying your utility bill. Just to do it.
And doing it is so much easier today for you, the listener. Think back to the 90s. If you wanted to buy stocks monthly...
Fees. You'd get killed by transaction costs. Like $8 a trade, sometimes more.
Exactly. Buying small amounts 12 times a year would cost you nearly $100 just in fees. It made regular small investing kind of prohibitive.
But technology changed all that. Free trading platforms, fractional shares.
Huge difference. The ability to buy, say, $10 worth of an index fund instead of needing hundreds for a single share. Game changer.
Plus cheap diversification through ETFs and index funds. All that friction is gone. JKB is literally the most cost-effective strategy out there now.
So what we're doing today is taking this simple three-word mantra, JKB, and applying it across your whole financial life, from saving money to, even thinking about market timing.
We're going to use the data to tackle some complex questions,
Right.
like why you might actually need less saved for retirement than you think, and, crucially, where you should be focusing your financial energy right now.
Let's start with that prioritization piece.
Okay, part one, the save-invest continuum. This is all about figuring out where to put your most valuable asset. Not your money, but your time and your mental energy.
Yeah, and we frame this with a statement that's, it's meant to be a bit provocative. The idea is saving is for the poor and investing is for the rich.
Okay, need to unpack that carefully. We're not talking rich or poor in the, the usual sense.
Not at all. It's strictly relative, based purely on how much financial capital you've accumulated. If you're just starting out, maybe you have a few thousand saved. In financial capital terms, you're relatively poor. Your main engine for growth has to be saving more.
But if you've already built up, say, a multi-million-dollar portfolio,
Then you're relatively rich in financial capital. And the main driver of your wealth changes. It's not your savings anymore, it's your investment performance, how that portfolio behaves.
and knowing where you are on that spectrum, it completely changes where you should spend your energy. I love the example you use of the recent grad.
Right. Picture this. A 23-year-old, maybe living in an expensive city like San Francisco. They've done well. They've managed to scrape together their first $1,000 in a retirement account.
Awesome start.
It is. But then analysis paralysis kicks in. They spend hours, maybe hundreds of hours, totally obsessing over the asset allocation.
Oh, yeah. Should it be 80% stocks or 75%? Is 15% bonds enough, or is 20% too safe? Agonizing over fractions of a percent.
Well, simultaneously, because they're young and social in San Francisco, they're routinely dropping $100, maybe more, on a single night out.
Oh.
Dinner, drinks, Uber with colleagues.
And here's the simple math that just hits you like a ton of bricks.
A fantastic 10% return on that $1,000 portfolio. That's $100 for the entire year.
That one night out just wiped out their whole year's potential investment growth.
Exactly. The time spent agonizing over whether it's 15% or 20% in bonds, it's completely wasted effort at that stage.
The return on energy for tweaking the investment mix is basically zero.
Whereas the return on energy for focusing on saving discipline, maybe cutting back on those expensive nights, finding a cheaper place, whatever, is massive, exponential, really. Savings discipline totally trumps investment strategy early on.
Okay, so that's the early stage.
Yeah.
How does it flip for the person who's further along, the relatively rich investor?
Let's take someone who's already got, say, $10 million in investable assets. A pretty common market dip, maybe 10% down.
Which happens fairly often, even within a single year sometimes.
Right. That 10% dip instantly loses them $1 million. $1 million. Unless they're earning, many millions a year, their annual savings contributions just can't possibly keep up with those kinds of portfolio swings.
A single bad quarter in the market could erase like 3 or 4 years worth of their diligent saving.
Precisely. So for them, the focus absolutely has to shift. It's all about the investment details now. Risk control, tax loss harvesting where assets are located, taxable versus tax-advantaged accounts, fine-tuning diversification.
Their energy needs to go into preventing or mitigating that potential $1 million loss, not optimizing the extra $20K they might save this year.
Which is now just a rounding error on their $10 million base.
So how does someone listening right now figure out where they are on this continuum? Should they be stressing about saving more or digging into investment strategy?
There's a simple formula for this. You need to compare two numbers, and importantly, they need to be in dollar terms, not percentages.
Okay, number one.
Your expected annual savings contribution. How much new money do you realistically plan to invest over the next 12 months? Get a dollar figure for that.
Got it. And number two.
Your expected annual investment growth. You can estimate this pretty easily. Take your current total portfolio value and multiply it by a reasonable expected annual return, maybe use 8% or 10% to be conservative. That gives you a dollar figure for what the market might earn for you.
Okay, so I have my savings dollars and my expected growth dollars. Now what?
Compare them. If your expected savings number is way higher, like you plan to save $15,000, but your current portfolio is only expected to grow by, say, $5,000, then your focus needs to be overwhelmingly on savings. 90% of your energy goes into boosting contributions, cutting costs, finding ways to save more.
And if it's the other way around, if my portfolio growth is expected to be much larger than my new savings,
then you pivot. Your energy shifts to investment strategy, tax efficiency, asset allocation, risk management, because that's where the bigger dollar impact is.
what if they're kind of close?
Then you focus on both. It means you're likely in that transition zone. But this comparison gives you a clear, data-driven way to prioritize your limited time and energy.
And you can actually see this shift happen visually over a lifetime.
Oh, yeah. If you look at a chart showing wealth growth over, say, 30 years, in the first decade, maybe even decade and a half, it's those annual savings contributions that are doing most of the heavy lifting. They're driving the majority of your net worth increase each year.
But then, gradually,
The balance shifts. By the end of a typical working career, the picture flips completely. It's the investment gains, the compounding, the market appreciation that account for the vast majority of your total wealth. Maybe 70% or even more comes from growth, dwarfing the sum total of all your contributions.
so saving gets you started, but investing is what gets you over the finish line.
Perfectly put. Saving ignites the engine, investing provides the long-haul fuel.
Okay, that initial focus on saving leads us right into part two, where we have to tackle what we're calling the saving paradox. And we really need to start by pushing back against some super common, but honestly, pretty rigid financial advice you see everywhere.
Oh, it's all over the internet, isn't it? These static rules like you must save exactly 20% of your income, or you absolutely need 1x your income saved by age 30.
And the core problem with that kind of advice.
Which, by the way, academic research totally backs this up, is that it assumes your life is static. It assumes your income, your ability to save, your expenses. None of that changes, which is just not reality for most people.
Life happens. Things change. Your financial life is rarely, if ever, static.
We should think about it more biologically, actually. There's this concept called phenotypic plasticity.
Okay, biology lesson time.
Stick with me. Think about the Dolly Varden char. It's a fish, lives in cold Alaskan streams. When food is scarce, like really scarce, this fish physically shrinks its digestive organs to save energy.
Seriously. It shrinks its own stomach.
Yeah. Then, when the salmon run starts and there's suddenly tons of food, its digestive tract expands rapidly, sometimes doubling in size, to handle the feast. It physically adapts to abundance and scarcity.
So our finances should be like that fish.
Exactly. Our finances need that same adaptability. When things are great, you got a big raise, job secure, expenses are low, save like crazy, maybe hit 40% or more.
But if things change, maybe you move to a much more expensive city for a great opportunity, or there's a family emergency, or you have kids.
Your savings rate might have to plummet. Maybe it goes from 40% down to 4% for a while. Trying to rigidly force yourself to hit that arbitrary 20% rule when life throws you a curveball, that just creates immense stress.
And stress is the enemy here, right? We know this.
The data is crystal clear. Money has been the #1 stressor for Americans basically every year since the American Psychological Association started tracking this stuff back in 2007.
So if trying to hit some generic savings percentage makes you anxious and miserable,
you're losing the psychological battle, which is arguably more important. The best savings advice is actually the simplest. Save what you can, and figure out how to do that in a way that doesn't stress you out.
Okay, so how do you figure out what you can save without driving yourself crazy?
Back to basics. The simple equation. Savings. Income spending. Income is usually the easy part. You know what's coming in each month.
Spending, that's the tricky one. It fluctuates.
It does. And this is where we push back against the idea of tracking every single penny, every receipt. That often just adds more stress.
So no obsessive budgeting apps.
Not necessarily. Instead, focus on the big rocks. Figure out your fixed spending, rent or mortgage, subscriptions you know you have, car payments, student loans, etc. Nail those down.
And the rest. Groceries, gas, entertainment.
Stuff that varies.
Estimate it. Use reasonable approximations. If you generally spend around $100 a week on groceries, just pencil in $400 for the month. Be a little generous with the estimates even. It's about understanding the rough landscape, not mapping every single blade of grass. Less detail, less stress.
Okay, that makes sense. But now we have to tackle what you call the biggest lie in personal finance.
Yeah, this one gets repeated constantly, almost like a mantra. It's the idea that simply cutting your spending is the path to getting rich. Just skip the latte and you'll be a millionaire, that kind of thing.
Exactly that kind of thing. And it's not just unhelpful, it can be actively harmful because it ignores the economic reality for a huge chunk of the population.
You looked at the actual data, right? The Consumer Expenditure Survey.
We did, specifically focusing on the lowest 20% of U.S. households by income. And the results are, frankly, pretty sobering.
What do the numbers show?
Consistently, going back decades, these households spend over 100% of their after-tax income on just 4 basic necessities: food, healthcare, housing, and transportation.
Wait, over 100%, meaning they're going into debt just to cover basics?
Effectively, yes. Or relying on other support. Let's use 2019 numbers to make it concrete. The average after-tax income for that lowest 20% group was about $1,020 a month.
Okay.
Their average spending on just those 4 necessities, food, healthcare, housing, transport, was $1,947 a month.
Wow, almost double their income just on the absolute basics.
So telling someone in that situation to cut their spending to save money, they literally have to cut their spending on essentials in half. It's mathematically impossible. It's unrealistic.
And telling them the problem is their $5 coffee habit is just insulting, really.
It's condescending because it completely ignores the massive fixed costs they're drowning under.
Yeah.
They don't have a spending problem. They often have an income problem or a cost of living problem.
So why is it generally easier for higher earners to save a larger percentage? Is it just willpower?
Not really. It comes down to a core economic principle,
Yeah.
diminishing marginal utility. Think of it as the law of the stomach.
Okay, more analogies. I like it.
That first slice of pizza when you're starving, pure bliss, right? Worth every penny. The third slice, meh, it's okay, but it gives you way less satisfaction than the first, even though it costs the same.
Got it. The enjoyment per dollar goes down.
Exactly. And this applies directly to necessities. Let's compare the top 20% of earners to the bottom 20% again, using that 2019 data. The top group made about 14 times more after-tax income than the bottom group.
14 times. That's a huge gap.
It is. But did they spend 14 times more on necessities? Food, housing, healthcare, transport?
Probably not. You don't need 14 houses or 14 times the groceries.
Precisely. They only spend about 3.3 times more on those core necessities because spending on basics doesn't scale linearly with income. Once your essential needs are met, extra income doesn't need to go to survival.
Which means the wealthy just naturally have a much larger surplus left over after covering necessities. It's not necessarily about being more frugal. It's about the math of high income versus fixed basic costs.
Right, and research confirms this creates a kind of poverty trap. There was a fascinating study by the London School of Economics in Bangladesh.
What did they find?
They worked with female villagers. What they found was that the primary constraint wasn't a lack of motivation or talent, it was a lack of initial wealth. When they randomly gave some villagers enough assets like livestock to get them above a certain minimum threshold, those villagers generally escaped poverty and thrived long term. But if they gave them an amount just below that threshold, they usually failed and slid back into poverty.
So you need a certain amount of starting capital to even get escape velocity. Willpower alone isn't enough.
That's what the evidence suggests. Wealth often requires some initial seed capital to get started, which makes that skip the latte advice even more frustrating.
Because even if you did save that $5 a day, turning it into $1 million requires some truly heroic assumptions.
Oh yeah. Usually assumes things like getting 12% annualized returns for decades, which is way above the historical market average of maybe 8–10%. It ignores taxes, inflation. It's a mathematical fantasy designed to make people feel bad about small pleasures.
So if aggressively cutting spending isn't the reliable path for most people, what is?
It comes back to the other side of the equation, growing your income, focusing on building your human capital.
Human capital meaning?
The economic value of you, your skills, your knowledge, your experience, your time, and then finding ways to convert that value into actual financial capital, into dollars.
Okay, how do people typically do that? What are the paths?
Well, we looked at about 5 common paths. The simplest is just selling your time or expertise, like consulting or freelancing by the hour.
Downside being, it doesn't scale well. You only have so many hours in a day.
Exactly. Ceiling is pretty low. Second path is selling a specific skill or service, maybe graphic design, writing, coding. Often pays better, you can build a brand, but you're still trading time for money, fundamentally.
What about more scalable options?
Third is teaching people. Think online courses, workshops, digital content. You build it once, potentially sell it thousands of times. Highly scalable.
Fourth is similar. Selling a unique product, especially a digital one. Software, ebooks, templates. Build once, sell infinitely. Solves a problem for people.
These are great, but it's important to note the most common path to building significant wealth in America isn't necessarily starting a tech company or becoming an influencer.
What is it then?
It's still climbing the corporate ladder, getting promotions, pursuing professional degrees, doctors, lawyers, engineers, gaining expertise and seniority within established structures.
Interesting. And the data on entrepreneurs.
The typical successful entrepreneur isn't a 20-something in a hoodie. The average age is closer to 40. They often spend years building skills, networks, and capital in a traditional career before branching out.
So corporate life isn't necessarily selling out. It can be a very effective wealth-building strategy.
Absolutely. But the ultimate goal, no matter the path, should be ownership. Owning assets that generate income, not just relying on your labor.
Like the Jerry Richardson example.
Perfect example. Played briefly in the NFL, wasn't a superstar, made his real fortune owning Hardee's fast food franchises, and eventually owning the Carolina Panthers NFL team. His massive wealth came from ownership, not his player salary.
Okay, so focus on income, aim for ownership. But once you do start earning more, how do you actually enjoy spending some of it without feeling guilty? That saver's guilt is real.
It is. So we need a psychological trick. We call it the 2x rule.
All right, what's the 2x rule?
Simple. If you want to splurge on something non-essential, say a $400 fancy gadget or a weekend trip, you have to immediately match that spending amount with an equal investment.
So spend $400 on the gadget, immediately invest $400 in, say, an index fund.
Exactly. Or, alternatively, donate that matching $400 to a charity you care about.
Ah, okay. So it creates this instant psychological balance.
Precisely. It frames the splurge as guilt-free. You got the thing you wanted, but you simultaneously did something positive for your future self, investing, or for the world, donating. It short-circuits the guilt mechanism.
I like that. What else helps with guilt-free spending?
Shifting your focus. Stop trying to maximize momentary happiness and start thinking about maximizing long-term fulfillment.
Happiness versus fulfillment. What's the difference in this context?
Happiness is often fleeting. Watching a funny movie makes you happy for 2 hours. Fulfillment is deeper, more enduring. Think about training for and running a marathon.
Yeah, the actual running part might not be happy moment to moment. It might be painful.
Exactly. But the sense of accomplishment, the discipline, the achievement that provides deep, lasting fulfillment. We should aim our spending more towards things that build fulfillment.
How do you identify those things? Is there a framework?
Yeah, Daniel Pink's framework is really useful here. He talks about 3 core drivers of intrinsic motivation: autonomy, control over your life; mastery, getting better at things that matter; and purpose, contributing to something larger than yourself.
So use those as a filter for spending.
Right. Ask yourself, does this purchase enhance my autonomy, mastery, or purpose? If spending $1,000 on a really good home office setup allows you to work more efficiently and deepens your occupational mastery, that's justified fulfillment spending.
If that daily $6 latte genuinely helps you focus and perform better at work, contributing to mastery.
Then maybe it's justified. But if it's just a mindless habit providing fleeting pleasure but no real fulfillment, maybe that's the spending to cut, not because of the $6, but because it doesn't align with deeper goals.
It makes it about values, not just dollars.
And it has to be personalized. Research actually shows that spending money in ways that match your specific personality profile leads to higher life satisfaction than your total income level does.
So an introvert spending on quiet hobbies might get more fulfillment than spending the same amount on big social events, even if society pushes the latter.
Exactly. There's no single right way to spend. It's about finding the ways that maximize your personal sense of fulfillment and align with your psychological makeup.
All right, let's move into part 3. We're talking about the big ticket items now, the major financial decisions, and eventually retirement. We have to start with the silent killer of wealth.
Lifestyle creep.
Ah, yes, lifestyle creep. It's insidious. The classic cautionary tale here is the Vanderbilt family.
The railroad tycoon, Commodore Vanderbilt.
That's the one. He built an absolutely enormous fortune. In today's money, something like $5 billion. Just staggering wealth.
And yet,
within about 75 years of his death, that entire fortune was basically gone, dissipated, lost. How? How do you blow through $5 billion?
uncontrolled, accelerating lifestyle creep. We're talking levels of extravagance that are hard to even imagine. Dining on horseback indoors, apparently smoking cigarettes wrapped in $100 bills, just constantly escalating consumption.
Wow. Okay, so their spending just completely outpaced any growth or income from the capital.
Exactly. Extravagant consumption will always overwhelm compounding if you let it run wild. So we need a defense mechanism, a simple rule to prevent that happening to us even on a smaller scale when we get raises or bonuses.
What's the rule?
It's really straightforward and surprisingly effective. Save 50% of your future raises and bonuses.
Just half. Commit to saving half of any new income that comes your way.
Yep. If you get a $10,000 raise, earmark $5,000 of it for increased savings or investments before you think about spending the other $5,000.
So 50%, what's magical about that number?
It keeps your forward momentum going. If you spend more than 50% of your raise, you actually start delaying your potential retirement date, compared to if you hadn't gotten the raise at all. The 50% mark seems to be the break-even point for maintaining your timeline.
Okay, that makes sense. But I read something fascinating in the research about people who are already saving a lot. Does this rule still apply? Like if someone's already saving 40% or 50% of their income?
Ah, you picked up on the high saver trap. This is where it gets really counterintuitive and interesting.
Lay it on me.
If you are already a very aggressive saver, let's stick with the 50% savings rate example, you cannot just save 50% of your next raise to maintain your retirement trajectory.
Wait, what? If I'm saving more, shouldn't a raise help me retire faster?
Logically, yes. But to simply maintain the same retirement timeline you were on before the raise, that 50% saver actually needs to save a much larger percentage of the new money. In that specific case, the math shows they need to save about 74% of the raise.
74%. Why is the math so much harsher for the super saver?
It's because their spending base is already so low. If you're saving 50%, you're only spending 50%. That $10,000 raise represents a much, much bigger percentage increase relative to your small spending base compared to someone who is only saving 10% and spending 90%.
So any lifestyle creep from the raise has a disproportionately larger impact on the high saver's low spending level, potentially pushing their retirement date out further if they don't save most of the raise.
You got it. The 50% rule is a great, simple heuristic that works well for the majority of people saving in the, say, 10% to 25% range. But if you're already a saving superstar, you have to be even more disciplined with new income to keep things on track. It's a weird paradox.
Good to know. Okay, next big topic, debt. The standard advice is basically debt interest to bad. Avoid at all costs, especially credit cards, but you're saying we need more nuance.
Absolutely. Debt is just a tool, like a hammer. You can use it to build a house or you can hit your thumb with it. It's not inherently good or bad, it depends how you use it.
So, when can debt be a useful tool? Let's start with that weird borrower-saver puzzle. People holding credit card debt even when they have savings.
Yeah, it seems irrational on the surface, right? Paying 20% interest on a credit card while earning maybe 1% in a savings account. But it can be a form of risk management, almost like bet hedging.
Hedging against what?
Think about desert seeds. Some seeds have evolved to not germinate, even when conditions are perfect, just in case there's a sudden drought later. They hold back as insurance.
Okay.
Some people do the same with money. They hold on to liquid savings, their safety net, and simultaneously carry some high-interest debt because they're worried about future access to credit. What if they lose their job next year and then have an emergency? Will they be able to borrow then?
So they pay the high interest now as a sort of insurance premium to guarantee they have liquidity later, just in case they can't borrow when they really need it.
That's the theory, and we see behavior consistent with it. We even saw an example from India. A woman named Seema took out a high-interest loan she didn't strictly need because the high interest acted as a forced savings mechanism. It compelled her to prioritize repaying it quickly while keeping her own savings untouched for true emergencies. It's complex psychology.
Okay, so that's a niche case. What about more broadly justifiable debt?
Debt is generally justifiable if it does one of two things. Either it reduces risk or it generates a return greater than its cost.
Examples of reducing risk.
Holding on to a low fixed-rate mortgage can provide payment stability and security, which reduces risk compared to, say, rising rents. Maintaining a healthy emergency fund, even if you carry some low-interest student debt, reduces the risk of being forced to sell investments at a bad time.
And generating a return.
That's the more obvious one. Debt for education that increases your earning potential. Debt to start or expand a business. Debt to buy a home, which, while maybe not a great investment, provides housing utility and potential appreciation. The expected return, financial or utility, outweighs the interest cost.
But the warning label on certain kinds of debt is still absolutely critical, right?
Absolutely non-negotiable. The research is incredibly consistent here. Non-mortgage debt, specifically credit cards, payday loans, even informal loans from family and friends, is strongly linked to negative outcomes.
Like what?
Higher stress levels, increased rates of depression, even measurable physical effects like higher blood pressure. It weighs on people psychologically.
But mortgage debt doesn't seem to have the same negative impact.
Generally, no, because it's usually seen as good debt. It's typically fixed rate, long-term, secured by an asset, and it's facilitating homeownership, which has positive social and personal connotations. It doesn't carry the same mental burden as high-interest, revolving consumer debt used for, well, consumption. Avoid that stuff if at all possible.
Okay, let's talk about the biggest debt most people take on, the mortgage. Is buying a house actually a good investment?
If we're talking purely financial returns, the data says probably not. Not compared to other options anyway.
Really? Everyone talks about home equity, building wealth.
It does, but slowly. The Nobel laureate Robert Shiller did the benchmark study. He calculated the real inflation-adjusted return on U.S. housing from 1915 all the way to 2015.
And the result?
Only 0.6% per year after inflation.
0.6%. That's barely keeping pace with inflation.
Exactly. Housing is a fantastic inflation hedge, and it acts as a forced savings mechanism because you have to make the payment. It's much less volatile than stocks. But is it likely to be your ticket to massive wealth? Probably not. Stocks historically blow it out of the water on pure returns.
So if the financial return is so mediocre, why buy? Why is homeownership such a big part of the American dream?
Because the reasons are overwhelmingly non-financial. Stability for your family, putting down roots in a community, access to specific school districts, the freedom to renovate and make it your own space. These things have immense personal value.
And it is a primary wealth builder for some groups, right?
Absolutely crucial. For many low to moderate income households, their home equity represents the vast majority, sometimes 75% or more of their total net worth. It's the main way they accumulate assets over the long term, so it serves different purposes for different people.
Okay, so if you decide the non-financial benefits are worth it, when is the right time to buy?
The key word is stability. Personal stability, professional stability. You really need to plan on staying put in that home for at least 5 years, preferably 10 or more.
Why so long?
Transaction costs. Buying and selling a house is incredibly expensive. Real estate commissions, closing costs, title insurance, moving expenses, it all adds up. If you buy and sell too quickly, those costs can easily wipe out any equity you've built.
What else do you need financially?
Ideally, you want to be able to afford a 20% down payment. That lets you avoid private mortgage insurance, PMI, which is basically just extra money down the drain.
And that DTI ratio you mentioned earlier.
Critical. Keep your debt-to-income ratio, all your monthly debt payments, divided by your gross monthly income below the standard qualified mortgage threshold of 43%. Below 36% is even better. It shows lenders you can comfortably handle the payments.
What about starter homes? Buy small now, trade up later.
The analysis actually suggests skipping the starter home if you can.
Really? Why?
Again, those transaction costs. If you buy a small place knowing you'll outgrow it in 3-4 years, you'll likely pay all those buying costs, then pay all the selling costs, then pay all the buying costs again for the bigger house. It's often financially better to wait, save a bit longer, and buy the house you plan to stay in long term. Avoid paying those fees multiple times if possible.
Makes sense. Okay, let's talk about saving for that big down payment. How should you invest that money?
The single most important factor here is your time horizon. How soon do you need the money?
Short term, say, less than 2 years away from buying.
Cash, or cash equivalents like high-yield savings accounts or money market funds, nothing else.
Why not even safe bonds?
Because even relatively safe intermediate-term treasury bonds can, and regularly do, drop 3% or more in value within a year. If you're aiming for your down payment in 18 months and your bond fund drops 3% right before you need the cash, that might mean you have to delay buying or scramble to save thousands more at the last minute. You simply cannot afford any principal risk on short-term goals.
But what if your home purchase is further out, 5 years, 10 years?
Then holding cash actually becomes the riskier strategy.
Riskier than stocks and bonds. How?
Inflation risk. Inflation erodes the purchasing power of your cash over time. The analysis showed that if you were saving, say, $60,000 for a down payment over 5 years entirely in cash, historically, you would have needed to save for an extra 7 months, on average, just to counteract the value lost to inflation.
Wow. So over longer periods, cash is guaranteed to lose value in real terms.
Exactly. For a 5+ year goal, you need some growth potential to maintain your purchasing power. That means a balanced portfolio, maybe 60% stocks, 40% bonds, adjusted based on your specific timeline and risk tolerance. You need to outpace inflation.
All right, this all leads to the ultimate question. When can you finally retire? The financial answer often revolves around the famous 4% rule.
Yeah, the 4% rule is kind of the standard starting point. It came from work by a financial advisor named William Bengen back in the 90s. He ran simulations using historical market data.
And what did he find?
He found that if you withdraw 4% of your starting portfolio value in your first year of retirement and then adjust that dollar amount upward for inflation each year after that, your money had a very high probability of lasting for at least 30 years, even through bad market periods, based on historical data, of course.
So it gives you a target number. If you want to spend $40,000 a year in retirement.
You need 25 times that amount saved. So $40,000 times 25 equals $1 million. That's your target portfolio value.
And it's 25 times your excess spending.
Right. Good clarification. It's 25 times your annual excess spending. That means your total desired annual spending minus any guaranteed income you already have, like Social Security or a pension. You only need your portfolio to cover the gap.
Is the 4% rule reliable? Or is it too aggressive, too conservative?
It's generally considered quite conservative for a few reasons. One, it assumes you never adjust your spending down, even in bad market years, which most real retirees actually do.
And it assumes your spending keeps rising with inflation every single year.
Right. But the empirical data on actual retiree spending shows the opposite often happens. Spending tends to decline slowly in real terms by maybe 1% per year on average as people age. They travel less, drive less, maybe downsize. Their needs often decrease.
So the 4% rule builds in a lot of safety margin because it assumes ever-increasing spending when reality is often declining spending.
Exactly. It means the actual historical failure rate of the 4% rule over 30 years is extremely low. It's a very safe starting point for planning.
But having the money is only part of the equation, isn't it? The bigger challenge might be existential.
That's often the case. Reaching financial independence is one thing. Successfully navigating the transition to not working is another thing entirely. Retirement isn't just a financial decision, it's a fundamental lifestyle decision.
Because work gives us more than just money.
So much more. Identity, social connection, structure, routine, a sense of purpose. When that disappears overnight, it can leave a huge void.
You mentioned Kevin O'Leary, Mr. Wonderful from Shark Tank.
Yeah, he's an extreme example, but illustrative. Sold his software company for billions, effectively retired at 36, and by his own account, he was bored out of his mind within months and desperately needed to get back to building things.
And we see this with the FIRE movement too, right? Financial independence, retire early.
Yeah, you hear stories from people who achieve FIRE in their 30s or 40s, and some find it, well, a bit empty, a lonely existence, some have called it. Many end up going back to work part-time, starting passion projects or consulting, just to regain that sense of purpose and connection.
So the crucial question isn't just, do I have enough money? It's,
what am I retiring to? What will fill that void? What new identity, purpose, social structure will replace what work provided? Solving the money problem doesn't automatically solve the meaning problem. You need a plan for your time, not just your money. Which brings us neatly to part 4, the investment imperative. Why investing isn't just a good idea, it's essentially a necessity if you ever want the option to stop working.
it comes back to that idea of human capital versus financial capital.
Right, exactly. Your human capital, your ability to earn income from your skills and time, is your biggest asset when you're young. But it's a dwindling asset. Every year you work is one less year you can work in the future.
So investing is the process of converting that temporary human capital
Into permanent financial capital. Assets that can work for you, generating income 24/7 long after you've stopped working your day job.
Is there a way to quantify how much financial capital you need to replace your human capital?
We can estimate it. Let's say you earn $50,000 a year and expect to work for 40 years. If we calculate the present value of that future income stream, basically, what that income is worth in today's dollars, discounting it back at, say, a 3% rate to account for time value of money.
What does that come out to?
It's roughly $1.2 million. So conceptually, you need to build about $1.2 million in financial capital and investments just to replicate the income-generating power of your human capital over those 40 years.
Investing is basically building your replacement worker, an army of dollars working for you.
That's a great way to put it. So what should you own in that army? The key is income-producing assets, things that generate cash flow.
Obviously, stocks are on the list.
Yeah.
Through diversified index funds mostly, what kind of returns do they offer historically?
Stocks, broadly, have delivered maybe 8–10% annualized total returns long-term, high growth potential, but also high volatility.
What about real estate besides your own home?
REITs, real estate investment trusts, are a good option here. They let you own a piece of large-scale commercial real estate malls, office buildings, data centers, without the hassle of being a landlord.
And their returns have been historically strong too.
Often even slightly higher than broad stocks, maybe in the 10–12% range, though again with volatility. And the key thing about REITs,
Ah, yes, the legal structure. Why are they so good for income seekers?
because they have a legal requirement. To maintain their tax-advantaged status, REITs must pay out at least 90% of their taxable income to shareholders as dividends.
So the income stream is basically baked into their structure. They have to pay you.
Pretty much. That makes them a very reliable component for generating income, especially in retirement portfolios.
Okay, what else is out there beyond stocks and REITs? Maybe less common stuff.
Farmland is an interesting one. Historically, returns around 7–9%. Its main appeal is low correlation to stocks. It often zigs when the stock market zags, and it's a fantastic inflation hedge.
Because when inflation goes up, food prices usually go up and farmland value goes up.
Exactly. Then you have the really high potential, high risk stuff. Small businesses or angel investing, potential returns, maybe 20, 25% or even higher.
But massive caveat coming, I assume.
Huge caveat. It's extreme skew. What that means is most angel investments fail completely. Like 89% might yield zero or negative return.
So the average is pulled way up by a tiny number of huge winners, like investing early in Google or Facebook.
Precisely. To succeed here, you need deep expertise, a strong network, and enough capital to make maybe 10, 20, or even more small bets, fully expecting most to fail, hoping one or two hit it big. It's not for the faint of heart, and it requires significant time commitment, not just money.
Any other income assets?
Royalties can be interesting. Things like music rights, intellectual property, energy royalties. Returns vary wildly, maybe 5–20%. Their main appeal is they're often totally uncorrelated to the stock market, providing diversification.
And you mentioned using the Lindy effect here. How does that apply?
Right, the Lindy effect, sometimes called dollar age. The core idea is that for non-perishable things, ideas, technologies, maybe even income streams, the longer they've already existed, the longer their future life expectancy is likely to be.
So a song that's been earning royalties for 50 years is probably a safer bet to keep earning than a brand new song.
That's the thinking. When evaluating assets like royalties, favoring those with a longer track record and older dollar age can help reduce the risk of the income stream suddenly drying up. It favors proven durability.
Okay, so that's a list of things to potentially own.
Yeah.
Importantly, what assets are excluded from this core income-producing list?
Yeah, this is key. We generally exclude assets that don't generate a reliable income stream. Their value depends entirely on someone else paying more for it later.
What falls into that category?
The big ones are gold, cryptocurrencies, art, wine, other collectibles, and commodities in general.
Why exclude them if they can go up in value?
Because they don't produce anything intrinsically. A bar of gold just sits there. A Bitcoin doesn't generate dividends or rent. Their price is driven purely by perception, speculation, and supply and demand dynamics. For building reliable long-term wealth, you really want assets anchored by underlying cash flows, things you could theoretically hold forever and live off the income.
Which leads us directly to a pretty strong conclusion based on data. The case against picking individual stocks.
Yeah, and this isn't just about the math, although the math is bad. It's also about the emotional cost.
You had a story about a friend during the GameStop mania.
Oh, man, yeah. Watched him go through the entire emotional roller coaster in about 2 hours back in early 2021. Pure FOMO, fear of missing out, driving him to buy near the peak, then that brief, intense elation as it spiked even higher, followed by gut-wrenching pain and regret as it crashed, wiping out like $12,000.
That emotional whipsaw?
It's brutal. And often that psychological damage, the fear, the regret, the second-guessing, is more destructive long-term than the actual dollar loss. When you buy an individual stock, you have to be emotionally prepared for it to go to zero.
And even if you could be perfectly rational, the odds of successfully picking winners are just terrible.
They're statistically horrifying, honestly. Forget individual investors. Look at the pros. About 75% of professional active fund managers, people with PhDs, huge research budgets, doing this full-time fail to beat their simple benchmark index over a 5-year period.
3/4 of the pros can't even beat the average.
Exactly. But here's the stat that really seals it for me. Research looking at all U.S. stocks since 1926 found that only the best performing 4% of all stocks accounted for the entire net gain of the stock market above what you could have gotten just holding treasury bills.
Wait, let me process that. Only 4% of all stocks ever listed were responsible for all the market's wealth creation.
Essentially, yes. The other 96% of stocks, in aggregate, basically delivered T-bill returns or worse over the long run.
So when you're picking individual stocks, you're not just looking for a needle in a haystack.
You're looking for one specific type of radioactive needle in a mountain-sized haystack, while the other 96% of the needles look identical but are duds. It's an incredibly low probability game.
Whereas buying an index fund,
You automatically own those winning 4% needles, along with everything else. You guarantee you capture the market's overall return, which is driven by those few huge winners. Why try to find them yourself?
and there's that existential dread piece too, right? Even if you think you're good at it.
How do you ever really know? The market's feedback loop is incredibly long and noisy. It can take years, even a decade or more, to determine if your good results were due to actual skill or just dumb luck.
Maybe your stock went up for reasons totally unrelated to your brilliant analysis.
Happens all the time. Maybe they got bought out, maybe a competitor stumbled, maybe the whole sector got hot. Was it your insight or just random chance?
It's almost impossible to disentangle skill from luck in investing over shorter periods. So why play a game where you can't reliably tell if you're actually any good?
My thoughts exactly. Stick to the diversification offered by index funds and focus your energy elsewhere.
Okay, part 5 is all about strategy, timing, luck, and dealing with the market's inevitable bumps. Given our just keep buying philosophy, the core timing rule has to be simple, right?
Super simple. Buy quickly, sell slowly. The logic follows directly from JKB. If we expect markets to generally trend upwards over the long term,
Which history strongly suggests they do.
then waiting to invest usually just means you end up paying higher prices later. So when you have money available to invest, the default action should be to invest it promptly.
This is where the data comparing investing a lump sum versus spreading it out comes in, right?
Yeah.
Buy now versus average in.
Exactly. Let's say you get a $50,000 bonus. Buy now means investing the whole $50 immediately. Average in, which is essentially dollar cost averaging, DCA, means maybe investing $10K a month for 5 months.
What does the history show? Which strategy performs better?
Overwhelmingly, buy now wins. The historical analysis shows that investing the lump sum immediately outperforms averaging in about 76% of the time.
76%. And the return difference.
On average, buy now leads to about 4% higher returns annually compared to averaging in over the same period.
Because the money is just working for you in the market for longer, time in the market beats timing the market.
Precisely. However, average in still has a really important role to play.
Which is?
Psychology. It acts as behavioral insurance. Think about the worst-case scenario for buy now.
Investing your entire lump sum the day before a massive market crash, like in 2008.
Exactly. The regret would be immense. Average in smooths out that ride. By spreading your purchases, you guarantee you won't buy everything at the absolute peak. You might sacrifice some potential upside, but you significantly reduce the risk of maximum regret.
So average in is less about maximizing returns and more about managing emotions and minimizing the chance of a catastrophic timing mistake.
Perfectly said. It's a tool for psychological comfort, which can be incredibly valuable in keeping you invested long-term.
Okay, let's absolutely demolish the most tempting myth for basically every investor. Trying to time the dip, waiting for the crash to buy cheap.
Ah, yes, the siren song of buying low. So we looked at a hypothetical scenario. What if you were a investing god? You had perfect foresight. You knew exactly when the market bottom would occur every single time.
Okay, so you always buy at the absolute lowest point. That has to be the best strategy, right?
You would think so. But the analysis is shocking. Even this godlike, perfect timing strategy, waiting in cash until the exact bottom, then investing underperforms standard, boring, mechanical dollar cost averaging, just investing the same amount regularly, in over 70% of the 40-year periods studied.
Get out. Perfect timing loses to just consistently buying most of the time. How is that possible?
Because the truly massive market drops, the kind where buying the dip would make a huge difference, are actually quite rare. If you're sitting in cash, waiting for that perfect 20% or 30% crash to deploy your money, you spend way too much time out of the market. And the market historically goes up about 3/4 of the time.
So while waiting for the rare big drop, you miss out on all the smaller, more frequent gains, the steady upward grind.
Exactly. You miss the compounding effect of simply being invested. The data is clear. Investing regularly, as soon as you have the money, is superior to trying to invest perfectly at the bottom, even if you somehow knew when the bottom would be.
Just keep buying strikes again.
It really does, which forces us to acknowledge the massive role that luck plays in our investment outcomes, particularly sequence of returns risk.
Meaning, when your returns happen matters just as much, or maybe even more, than the returns themselves.
Yes, definitely. I love the Stephen King, Richard Bachman analogy for this.
Remind us.
Stephen King, the famous author, published some early books under the pseudonym Richard Bachman to see if they'd succeed without his famous name attached. One Bachman book sold about 28,000 copies, respectable, but not blockbuster. Later, after Bachman was revealed to be king, they re-released the exact same book under Stephen King's name. Sales jumped to 3 million copies.
Wow. Same product, vastly different outcome, purely due to fame or branding or luck.
Right. The context mattered more than the content. Market luck is similar. Consider two hypothetical investors. Investor A is brilliant, beats the market by 5% every single year, but they invested from 1960 to 1980.
A period of generally low market returns, sideways action.
Exactly. Investor B is terrible. They underperformed the market by 5% every year, but they invested during the huge bull market from 1980 to 2000.
Who ends up with more money?
Investor B, the terrible investor, ends up significantly wealthier. Why? Pure luck of the draw. The timing of their investment window, the overall market environment they happened to invest in mattered more than their individual skill or lack thereof.
That's humbling. So what can we actually control if luck plays such a big role?
We can't control the market's sequence of returns, but we can control our own actions. We control how much we save, what diversified assets we choose to own, and the frequency of our investment.
The just keep buying part again. Control the inputs.
Exactly. By diligently controlling those variables, saving consistently, diversifying broadly, investing regularly, you maximize the probability that when good market luck eventually arrives, you'll be positioned to benefit from it. You control your preparation.
And part of that preparation is mentally preparing for volatility. You call it the price of admission, right?
You absolutely have to accept it. Volatility isn't a sign that something is wrong. It's a normal feature of markets, especially equity markets. It's the cost you pay for the potential of higher long-term returns.
How much volatility is normal?
Since 1950, if you look at the S&P 500, the average maximum drop within any given year, the to-trough decline, is about 13.7%.
So even in a year when the market finishes up 10%, it probably dropped almost 14% at some point along the way.
Very likely, yes. Most years involve a significant stomach-churning drawdown. You have to expect it and ride it out. Getting scared and selling during those dips is usually the worst mistake.
And the data on trying to avoid volatility is pretty stark too.
It's staggering. One simulation looked at what happens if you try to sidestep even relatively small drawdowns, say selling when the market drops 5% and waiting to get back in.
What was the result?
Over the long term, that volatility avoidance strategy resulted in 90% less wealth than a simple buy and hold strategy. 90%.
Why such a massive difference?
Because market timing is hard. If you're constantly trying to dodge small dips, you inevitably spend too much time sitting on the sidelines in cash or bonds, and you'll miss the sharp, unpredictable recovery days. The market's best days often happen right after the worst days. If you're out, you miss the rebound. You have to accept the downside to capture the upside.
Conversely, those big, scary crashes, they're often the best opportunities. You had an anecdote about a flower guy during the March 2020 COVID crash.
Yeah, it was surreal. March 2020, the market was in absolute free fall. Down 5%, 7% some days. Global panic. Everything felt chaotic. And I remember walking down the street, and there was just a guy calmly arranging flowers for sale on a street corner. Totally oblivious, or at least indifferent, to the financial meltdown happening.
What did that signify for you?
It was just this moment of grounding, a reminder that the world keeps turning. The market panic, while real in the moment, is ultimately just noise in the grand scheme of things. Life goes on. It provided a needed shift in perspective away from the fear.
And the data actually supports leaning into that fear, right? Buying when things look bleakest.
Absolutely. Historically, buying U.S. stocks when the market is already down 30% or more from its peak has typically led to annualized returns of over 10% during the subsequent recovery.
And if it's down even more.
Yeah.
Like 50%.
If the market gets crushed, down 50% or more, which is rare, think 2008, 2009, the subsequent forward returns have historically averaged over 25% per year. The message is clear. Extreme fear and market crashes are usually the absolute best times to be deploying capital, assuming you have a long time horizon. Be greedy when others are fearful, as they say.
Okay, let's bring it home with part 6. The final rules and the most important asset. We know the buying rule. Buy quickly. What about the other side? When should you actually sell your investments?
We stick to the mantra, buy quickly, sell slowly. Selling should be done deliberately and for specific reasons, not based on market noise or emotion.
What are the acceptable reasons to sell income-producing assets?
There are really only 3 main justifiable reasons. 1, rebalancing your portfolio back to its target allocation. 2, a fundamental change in your belief about the asset itself. 3, funding the life you need.
Let's take rebalancing first. This isn't about trying to boost returns, is it?
No, not primarily. Rebalancing is almost purely a risk control measure. Think about a standard 60% stock, 40% bond portfolio. If you just let it ride for, say, 30 years without rebalancing.
Stocks tend to grow faster than bonds, so the stock portion will get bigger and bigger over time.
Exactly. That 60/40 could easily drift to become 75% stocks, 85%, maybe even 95% stocks over several decades, which means your portfolio is taking on way more risk than you originally intended.
So rebalancing maybe once a year means selling some of the stocks that have grown.
And using the proceeds to buy more bonds, bring the allocation back to your target 60/40. This doesn't necessarily increase your long-term return, it might even slightly reduce it, but it significantly reduces your portfolio's volatility and potential maximum drawdown during a crash. It keeps risk in check.
Okay, reason two is a fundamental change in belief, like if a company's prospects genuinely sour.
Right. Or if the reason you bought an asset no longer holds true, maybe regulations change or management makes consistently bad decisions. This shouldn't be based on short-term price moves, but a real evidence-based change in the long-term outlook.
And reason three, funding the life you need. This sounds like prioritizing needs over wants.
Absolutely. This means selling assets to build up your emergency fund, pay off high-interest debt like credit cards, fund necessary education, or maybe even pay off your mortgage if that provides significant peace of mind.
And if you're selling a big winner, like a stock that's gone up 10x.
Sell slowly. Don't just dump it all at once. Selling gradually helps minimize the tax impact, spreading capital gains over years, and also reduces the potential for regret if the remaining shares continue to soar. The overarching rule is fund the life you need, safety, security, before you start selling assets to fund the life you want, aspirational purchases.
Got it. Now let's tackle the 401k dilemma. First, Roth versus traditional. People agonize over this.
It causes way too much stress. The core decision is actually pretty simple. Do you want to pay income tax on this money now, Roth, or later when you withdraw it in retirement, traditional?
So you should choose based on whether you think your tax rate will be higher now or in retirement.
That's the main factor. If you expect to be in a higher tax bracket in retirement, Roth might be better. If you expect to be in a lower bracket, which is true for many people, traditional is likely better.
Does one offer more flexibility?
The traditional generally offers more optionality. You get the tax deduction now, and then you have choices in retirement. You could potentially do Roth conversions during years where your income is low to manage the tax hit, or you might just end up paying a lower overall rate. Traditional leaves more doors open.
Okay, now for the really controversial take. You argue that maybe, just maybe, young people shouldn't max out their 401k beyond getting the employer match.
Yeah.
That goes against almost all standard advice.
It does. And it's based on looking closely at the actual numbers. The argument for maxing out relies heavily on the tax benefits compounding over decades.
Tax-deferred or tax-free growth sounds amazing.
It is good. But how much better is it than just investing in a regular taxable brokerage account, assuming you manage that account tax efficiently, using index funds, holding long-term, maybe some tax loss harvesting?
What does the analysis show?
The average estimated long-term benefit, the extra return you get from the 401k's tax advantages compared to a well-managed taxable account, is surprisingly small, something like 0.38% per year on average, less than 0.5%.
Okay, that's smaller than I expected.
And then you have to factor in 401k plan fees. The average expense ratio for funds within 401k is around 0.45%.
Wait, so the average fee is higher than the average tax benefit?
In many cases, yes. Now, this varies hugely by plan. Some have great low-cost funds, others are terrible. But on average, the fees can easily eat up or even exceed the tax advantage.
So the argument is that chasing that potentially tiny or even negative net tax benefit might not be worth the major downside of the 401k.
Which is illiquidity, locking up that money until you're 59 and a half or facing penalties.
Especially when you're young. And that money might be incredibly valuable for other things.
Exactly. That money might be far more impactful if used for a down payment on a house in your late 20s or early 30s, allowing you to start building equity and stability. Or maybe it's seed money for a side business, or paying for certification that boosts your income. Those uses could potentially offer a much higher return financially and personally than the marginal tax benefit inside the 401k. Liquidity has value, especially early in your career when you're focused on building human capital. Get the employer match that's free money, but maybe think twice about locking up everything beyond that.
Food for thought, definitely.
Yeah.
Okay, shifting gears to psychology again. The hard truth. You will likely never actually feel rich. Why is that?
It boils down to relativity. Wealth isn't an absolute number, it's a social comparison. The classic example is Jack Whittaker, the guy who won a $113 million Powerball jackpot.
What happened to him?
A lot of unfortunate things, but relevant here. Even when he reportedly still had $17 million left, he was apparently still playing the lottery regularly.
He had $17 million and didn't feel rich enough.
Apparently not, because once you reach a certain level of wealth, your reference points change, your neighbors change, your social circle changes. You start comparing yourself to even wealthier people.
This is related to the friendship paradox, right?
Exactly, applied to wealth. The friendship paradox basically states that, on average, your friends have more friends than you do. It sounds weird, but it's mathematically true because popular people with lots of friends show up in many more social circles.
How does that apply to wealth?
Wealthy people tend to be more connected and influential, so they are statistically overrepresented in our social and professional networks. This means most of us are disproportionately exposed to people wealthier than ourselves, making us feel less wealthy by comparison, even if we're doing objectively well.
So, unless you are literally the single richest person on the planet,
You can always point to someone richer and say, see, they're rich, I'm not. Studies show even households in the 90th percentile of income significantly underestimate how well off they are compared to the average. The goalposts constantly move. Chasing the feeling of being rich is likely a losing game.
which brings us, finally, to the asset that truly matters most, the one thing that transcends money.
Time. It's the only asset you cannot earn more of, you cannot buy more of, and you are spending every single second.
The thought experiment that drives this home is powerful. Would you trade places with Warren Buffett?
Yeah, imagine Warren Buffett at, say, age 87. Would
Yep.
you swap your life, your remaining years, for his entire multi-billion-dollar fortune?
Almost nobody says yes to that. You wouldn't trade your youth and remaining time for all the money in the world.
It instantly reveals what we truly value most. We value our time. Time is what allows compounding to work its magic. Time is what allows for perseverance.
It's like that incredible story of Dasrath Manji in India.
Amazing story. A man whose wife died because the nearest hospital was on the other side of a mountain. He spent 22 years, single-handedly, with just a hammer and chisel, carving a 360-foot-long path through that mountain to connect his village.
22 years of relentless effort, using time and persistence, not capital.
Exactly. He leveraged his time. For you, the listener, especially if you're younger, your time is where the biggest leverage is right now. Your income potential grows most rapidly in your first decade or so of working, usually ages 25 to 35.
So optimizing your career, your skills, your income during that high-growth time window.
Is far more impactful on your long-term wealth than agonizing over whether your first $5,000 investment portfolio has the absolute perfect bond allocation. Focus on maximizing the value of your time first.
Okay, let's wrap this deep dive up. We've covered a lot, but it all comes back to those core just keep buying principles designed to maximize your probability of success, regardless of what the future holds.
The key rules are clear. Focus relentlessly on growing your income, human capital. Use the 2x rule to spend guilt-free by matching splurges with investment or charity. Commit to saving 50% of future raises to combat lifestyle creep. Don't play the individual stock lottery. Use diversified index funds. Remember to buy quickly and sell slowly.
And overarching all of that, recognize that time is your single most valuable non-renewable asset.
We started this discussion focused on building financial wealth, but the reality, supported by data and psychology, is that you might never truly feel rich because wealth is relative. Time, however, is the ultimate equalizer and the foundation of compounding.
So we want to leave you with a final provocative thought to pay one. If you accept that you probably always find ways to earn more money, but you can never buy more time, what is the single most impactful action you can take today related to your career, your skills, your human capital to maximize the long-term value of that irreplaceable asset, your time?
Invest in your time and just keep buying.